we all know as we live longer, neither our lifestyle ever goes down with the reduction in our incomes or earning age getting over. No, nor our aspirations and dream come down, because that's the age when we want the best from the life as the earning responsibility has slightly reduced. Also, at the same time, the need for all the expenses on health also come up. So there is a key gap between our earning age and our spending age. And that gap has to be filled up by our wealth, not savings. And why doing savings is not enough, but creating wealth is important, is what we are going to look at in detail today. And in doing so, we will look at important and powerful concepts in A, how should one manage the money? B, how should one manage the investments? And C, how should one manage the wealth? When we look at money, that is income, there are few fundamental ways in which millennials or us we think. For millennials, income is important, but fulfilling their desires and needs is more important. So spending is very, very important. A generation before millennials, that is we, always have been brought up with a mindset of savings. So what we do is we put aside a part of our income. And for any happy and successful life, our age-old principle of savings is very critical. So the equation is income minus expense, or income minus savings is equal to expense. This is a moot question that all of us need to ask ourselves and plan ourselves accordingly, be it millennials or us. But even more important is one concept which I am bringing in between. That is in between of savings and wealth. In that journey, while we want to travel the journey of savings to wealth, we want to make sure that our savings are not taken away by any unforeseen, unplanned things, and our wealth creation journey is hampered. How does that happen? You suddenly become sick, you spend a huge amount on your improvement, betterment, hospitalization, etc., and it goes out of your savings. This happens only if you have not insured your health. So for all the ladies, it's very important to know that whether themselves, their family, their children, based on your standard of living, have enough and adequate health insurance. Quite a few who are traveling should also have international health insurance also. And this is the key basic to own. The way now we know that we need to have a car, we should have a health insurance. 50 to 60% of your families, of the audience here would be having, but I think that 30 to 40% may not still have it. And this is, health insurance is so reasonably priced that one dinner in a 5-star is equal to your health insurance premium. But if you don't take that trouble, it will hit you and take away a huge money. So, as one of the small but key learning, please make sure all you in the family, and maybe because we are very dependent on our teams and servants and staff, even they are health insured. Equally and more important is life insurance. And in that, what is more critical is early you start paying life insurance premium. It is very small, but a huge amount gets insured. and you get it at the end of either your earning journey, or it goes to your children. Either ways, it helps you substantially. There are other insurances also which I would request all of you to check, and that is about your home insurance, your jewelry insurance. No doubt, motor car is compulsory, so it would be there. And all of you know that staying in Beaumont, I myself faced fire, and because my house was insured, I got the rent as well as the loss of furniture. If the house would not have been insured, without a single mistake of mine, the fire happened on 32nd floor, but my house at 31 floor, first floor, got 4,50,000 liters of water, and I spent almost 1.5 to quarter to 2 crores on furniture to just get back my house in order. So it is this important. So what I said, I'm just repeating for the benefit. And if I go a bit English, if that helps by any chance, मैं ये बता रही हूं कि एक तो है हमने इनकम से पैसा बचाया जो सेविंग्स है, वो सेविंग्स को हमें बताना है वेल्थ, बट वो जर्नी में हमारा सेविंग्स जो ले जा सकते हैं इन बिटवीन, उससे हमें हमारी जात को प्रोटेक्ट करना है. वी हैव टू प्रोटेक्ट अवर सेल्स फ्रॉम अवर सेविंग्स ईटर, विच इज बाय टेकिंग इंश्योरेंस. नाउ व्हाई दिस होल need to put money to use? हमें ये करने की जरूरत क्या है? Why should we worry, take risk, put money somewhere? Why can't we just put it in the bank and we are so happy, or just put it in the home that, oh, I have saved 2 crore, 5 crore, 20 crore, 50 crore. Why not that? Why do we take all the trouble to put money into different instruments? The key reason is that most of you would know, say a Louis Vuitton bag. What was it costing you 5 years back? What is it costing you now? If you would have saved money and kept it aside, would it have helped you to buy the bag after 5 years the same money? No, because the prices have gone up. Prices of labor goes up, prices of material goes up. So what is this called, the price going up? It's called inflation. With rising population, rising consumption, and limited commodity and limited effort, the inflation sets in. So the money loses its power. Why do we have money? We have money to buy something today or tomorrow. But if tomorrow my money is same, but the value of the thing I want to buy has gone up, the price has gone up, the power of my money has come down. So it's called purchasing power. To protect my purchasing power with my savings, I have to fight inflation. Now, what does that mean? Let's have a look at this example. Assuming 6% inflation is what in an emerging economy like India persists, then a 5 lakh rupee household expense per month today after 10 years would become 9 lakh rupees. So 10 years from now, for the same lifestyle, you will need 10 lakh or 9 lakh rupees. 20 years from now, you will need 16 lakh rupees. And 40 years from now, for all our children, for their monthly lifestyle, if the same standard is maintained, would still cost 51 lakh. And you can imagine by that time, how many more gadgets, how many more services, how many more facilities would have come to increase our cost. So this is what the inflation is, how it eats our savings. And that is why savings alone is not the solution. Making return on your savings is what makes all the difference. If we are clear about this concept, that why our savings need to earn for us or grow for us, let's go to some of the other concepts. Now, they say There are seven wonders in the world. What is the eighth wonder? Eighth wonder is the power of compounding. What is power of compounding? I put 100 rupees for generating return. Either that 100 rupee generates 15 rupees in a year, I consume that 15 rupees. Once again, next year, 100 rupees earns another 15 rupees, right? But power of compounding means on that 100 rupees, which has become 115, I don't take away 15. So next year, my return will come on 115. A year later, it will come on 115 plus 15% return, not on 100. So it is called compounding return. Now, what happens when you do a simple appreciation, say for example at 8%, and you do compounding at the same return of 8%, or 10 lakh at 8% return for 50 years becomes 50 lakhs, 5 times. But at 10 lakh at 8% return for 50 years on compounded interest becomes 4 crore 69 lakhs. So that's the power of compounding. I'll show you also in a chart. We will put all these concepts together at the end to arrive at our way of creating wealth. But before that, we need to know that compounding is such a big machine. So if you see from year 1 to year almost 10, 11, the simple and compounding interest is going hand in hand. The moment you reach 25, 29, 35, 37, and 47 years, see the gap. Because your interest started or return started coming on that increased amount. So, this is the power of compounding. And it's the compounding which gives you inflation beating returns. Now, why did I say this? For two reasons. For you to realize not only the saving importance of saving, but savings for long term. So the longer the period for which you save, the power of money becomes very strong. So this concept I did explain you, which is very simple but powerful, that income minus expense is equal to saving does no longer work. What we really need to do is income minus savings, only that should be our expense. And why it is so important to start saving early and putting it for use is because when savings get channelized into right investment product for a long period of time and gives compounded return, you have a phenomenal wealth which you can't imagine. I will also introduce you where all you can put your savings for generating returns or appreciation. What is the nature of each of this asset class and how we should judiciously use it to suit our investment goals and our risk profile. Two things are very important. Like each of us have a different fashion sense. Each of us have a different temperament, either liking something very spicy or something very sweet. Each of us have a different temperament. And that is called our risk profile. Based on the temperament, we can choose our asset class. Let me introduce you to all the different asset classes which are available. Known to all of us, first and foremost is gold. Why gold is very important asset class? despite it is not put to use except for any industrial use is not there, but it is still very important, most important asset class, because the gold reserve in the world is finite, and gold is purchased with money. And what, if you all are aware, say Indian government, say US government, say European governments, what are they doing when any problem come? From the reserve banks, they start printing money. So dollar or euro or rupee is not finite. It can be increased anytime. But what is not possible to be increased? Gold. So when you put more money into system by printing, gold prices go up because that is finite. And so you would know that maybe when you were getting married, the gold was at 3,000 rupees. When your mother was getting married, it was 300 rupees. And before that, it was 30 rupees also. But continuously, without doing anything. Why do I say without doing anything? Because with gold, we are not building any factory, taking out any product, nothing. Just by buying a gold biscuit and keeping, the value of that just keeps increasing because the relative power of dollar, rupee, euro keeps going down because we keep printing it. So gold is an important asset class. What is the other benefit of gold? You go to US with one gold biscuit, go to a jeweler and put it on his table. He will also give you same money. You go to Japan, you will still get almost same money. And in India also you will get the money. So gold standard, 24 karat, 22 karat, 18 karat, there are standard prices. That is the another biggest advantage of gold. And you are stuck somewhere. You are wearing 4 bangles and you are like me on a trek and I need cash. I put that bangle, I'll still get money immediately. So it is liquid. So gold has these assets, these properties or virtues. Vis-a-vis that, let's compare, say, real estate. We bought a piece of land. We all know land has also appreciated tremendously over a period of time. Once again, because the stock is finite. But if you want to sell your piece of land, can you sell it overnight? No. Is there a standard price of that real estate? No. It depends on the buyer and seller's need, negotiation, and requirement. So also is the case with arts. When we buy a piece of art, we just love it. We pay any price, we buy it. But when we want to sell it, maybe the opposite person at that point of time knows that you want to sell it, so you will not get that right price. So they don't have a standard price across like a gold has. And it is not as liquid. As compared to these 3 physical assets, what are the other financial assets that we have? So in financial assets, apart from cash, we have 2 other important classes of asset. One which we call debt or fixed income. Why do we call debt or fixed income? Because mostly these instruments are secured and they carry a fixed rate of return. For example, there is 5% RBI bonds, which means it will every year give you 5% return. Then there are, say for example, fixed deposit from Titan. So that fixed deposit, if you put your money, every year you will get, say, 8% return. Then say there are debentures of SBI. If you buy those debentures, every year you will get, say, 9% return. Will that 1 lakh rupee put to debenture, which is generating 9% return, can it anytime become 5 lakh rupees? the prices go up so much. That's difficult because these fixed income instruments, their nature is to give you fixed return, and there is a particular life cycle or maturity at the end of which you get your original sum back. Now comes the most interesting instrument, which is what we call equity. What is equity shares? For a very, very simple understanding, equity shares is the way we become partner. Share is bhag. We become partner in any other business. So you decide whom do you want to become partner with. Do you want to become partner with somebody who's making coal? Do you want to make partner with somebody who's making car? Do you want to make partner with somebody who's making paste? Somebody who's making biscuits? Somebody who's making all the software for the world or pharmaceutical for the world? And why? So this equity as an asset class gives you opportunity to become partner with some of the best businesses in the world. And the world has evolved so much that you can buy one share, you can buy half share, you can buy 10 shares, or you can buy 10 lakh shares. Up to you. Now, what are the advantages of this asset class? And what are the disadvantages? So fixed income, for example, gives you 8% return. But when you become partner in any business, it does not guarantee any fixed return. Because all of you have seen in your lifetime what happened to your husband's businesses or your own businesses. Sometimes it does so well, then some competition comes, some rule changes, or you make some mistake in decision making, your business goes down, then once again it comes up. So in like that for equity shares, there are no fixed return. There are no fixed redemptions also. But if you develop a skill to decide which businesses are doing better, where should I partner, then there are good chances of you making money through appreciation and a bit through dividend. So this is the difference between different asset classes. Now what if you would have invested say 10,000 in different asset classes? The simplest being gold, silver, दिखता है, समझ में आता है, कुछ ज्यादा सोचने का ही नहीं, लेके रख देने का, तो आपका तो your 10,000 would have become what? 2,73,000. और भी कुछ नहीं करना, सिर्फ फिक्स्ड डिपॉजिट में बैंक में रखा तो it would have become what? 3,05,000. रिटायरमेंट प्लानिंग कर लिया, प्रोविडेंट फंड में रख दिया, so what would have happened? 4,23,000. A little more effort you would have done and become partner in businesses in India, then what would have happened to your 10 lakh? 28 lakh. This is the power of equity. And what return is this? Only Sensex return, which means all the stocks which are part of Sensex, Sensex has given this return. There are experts who then decide only a few stocks from Sensex. There are experts who go out of Sensex and buy other stocks which are upcoming. Then the returns could be better. But I'm saying let's go with the benchmark. But not to forget, if you would have put 10,000, you would not have been at 28 lakh. Why you would? I'll definitely reply, Alia. Give me a minute. Why you would not have got this 28 lakhs? Because when this 10,000 would have become 1 lakh, you would have thought my money has become 10 times. Let me encash it. If not at 1 lakh, at 10 lakh, so definitely would have come up with some requirement of a vacation or something else and you would have encashed it. So what is key in making 10,000 to 28 lakh? Discipline and a long term approach. When you make your mind disciplined and keep a long term vision and approach, why should you keep long term vision and approach? Because India is the youngest country. What do you really mean by that? It means that in China, majority of the population is becoming old. What happens when you become old? You buy at 70, would you buy n number of pairs of shoes and n number of bags and n number of clothes? Or at 30, you will buy more at 30. So a young country has the biggest consumption power. And because of that, the growth in India will continue to be very good. And that's how, when you invest for long term in businesses will continue to do well. And coming back to Alia's question, is investing in index funds better? I would say, if you are not full time into the business of investing and looking at different businesses, yes, investing into index is the best, because best businesses most liked by foreign and Indian investors, so very liquid with high governance standard, come into index. So Sensex comprises of 30 stocks, Nifty comprises of 50 stocks. So which 50 come into Nifty? Only those which are one amongst the best. So if you put money into that index, definitely your chances of making very good money are there, and you don't need to go into nitty-gritty of each of the businesses. So now let's take it forward. I was explaining this, the difference between different asset class. See, if you would have noticed, most of the families who are doing really well also, they have all their surpluses parked either in real estate, which is, say, definitely one house, one extra house, more house, land in the wherever they hail from, all real estate projects, etc., etc. Because of two reasons, frankly. Up till now, India has been not a full white economy. All the businesses and everything used to generate a lot of cash. And real estate is one asset class where a lot of cash gets parked. So that suited all businesses. That extra surplus cash, okay, go buy, say, a 5 crore flat, you have to pay only 2.5, 3 crore check, 2 crore cash is adjusted. So your surplus cash is parked and is protected. At the same time, when you buy something with clear title, say for example a property or a house or a flat or anything, for many years in India, the house prices kept on rising. So people were comfortable. ठीक है, पड़ा है ना, सेफ तो है, वो रोज शेयर का प्राइस ऊपर जाता है, नीचे जाता है, साला बीपी बढ़ जाता है. So they took the biggest advantage of equity market, which is liquidity, to their deterrent. क्योंकि रियल एस्टेट प्राइस भी लास्ट 10 साल में it has not gone up. Most of you ladies know your flat prices have not gone up in last 10 years. Earlier it had gone up a lot, not in last 10 years. Still, because you don't see the prices daily, you don't bother about it. इक्विटी में क्या, सीएनबीसी देख लिया, फोन पे देख लिया, इधर देख लिया, उधर देख लिया, प्राइस देख लिया तो डर गए. प्राइस घटा तो जैसे अपना पूरा वैल्यू घट गया समझेंगे. So a lot of people, including a lot of really wealthy people in India, do not have an equity portfolio, because somewhere or other their understanding about equity, if you ask me, is faulty. A, they buy based on tips. B, they think they buy a particular share but do not visualize buying a share means becoming a partner in that business. They see it from the daily price movement only. So they don't bother to first check, whom can I become partner with? Do I become partner with someone who's really having very good business, very good balance sheet? What is balance sheet? Balance sheet means that Hema is running her house from the income which Chetan is giving. But say Lina is running her house by income which Samir is giving, plus always goes and asks more from others, borrows, keeps on borrowing because her expenses are more than her income which Samir gives. Whom do you think is doing a better job, Lina or Hema? Hema. Because Hema is not borrowing. Hema is running the show from her own resources. So, similarly, businesses which generate cash, which generate profit, do not borrow much, are good businesses. But you don't have time to go through all that. What you do, somebody told you buy this. No, why did he tell you? People who want to really invest and are in the business, they don't come and keep telling you. Those who have some intention keep coming and telling you. But you don't find out even one. Okay, what is their business? How much are they earning? How much are they borrowing? Without finding anything, we'll buy. Then when price fall, we don't know whether the business is really good. We sell and we book loss. And with those few experiences, we stop the whole journey of wealth creation, as I say. Because as what we explained, there are fixed income generating assets and there are capital gain giving assets. So when the appreciation is there, if you manage the discipline in your mind of not seeing the daily price volatility and getting disturbed, you will go into a long journey of wealth creation. One more small example I'll give before we go into the other powerful concepts is about physical gold and sovereign gold bond. So now government has come out with these gold bonds where apart from the gold price appreciation, you get 2.5% interest. And I just taught all of you that return is so important because any return makes ultimate gain, value much more powerful. And these sovereign gold bonds have no capital gain tax. So supposing you want to plan, now the youngsters in the, we all are at an age where our children will plan for their future and their children's future. So I would say every birthday, just keep giving them gold bonds. So at a particular age, when they need it, they will have enough of it which they can exchange without any capital gain, no GST, till the time interest comes and the gold parity price, you will get the gold at the time of wedding or anything. So this is very important instrument to plan for long term. So when you need to buy gold, you are ready with it until the time you get return also. Here we cover the whole financial assets risk matrix. Because every time you want to have any return, there is risk is associated. So when you want to be in a capital preservation mode, when you want very low risk to medium risk, then you go into short-term deposits, government paper, money market funds. Each of these instruments I can explain at length, but right now we will keep it to broad concepts. When it comes to income generating instruments, you can go into debentures, you can go into bonds, and you can go into fixed deposits. But when you want to grow your capital, for example, Alia asked us a question. Now, right now is the best time for Alia to plan her wealth. Why? Because A, she has a long period during which, supposing she buys a particular business in India, let's once again come back to Titan. So, over 20 years from now, Titan, for example, will enter from or grow from say 1100 stores to maybe say 10,000 stores, from n number of cities to so many more number of cities, And above all, what's going to happen is, as the country grows, our purchasing power, which means average income of any household, keeps growing. So earlier, say when I was 23, a fresh CA, and when I started my journey, I would have bought, for example, a small gold chain. After 10 years, I started buying beautiful earrings. And after 20 years, I started buying much bigger sets. Okay, because my income level grew. Now, what has happened to each of our lives happens on a mass scale. So when India is young and such a large population will go through that income increasing phase, they will keep spending more and more spending. Now, Titan is just one thing on which they will spend, whether glasses of Titan or whether some jewelry piece or watches. But such businesses will continue to grow. And of course, they come from the best of the houses. So, over such a longish period, if you remain invested in these businesses, imagine how much the businesses will grow. And what are stock prices? They are reflection of the underlying economy and business. So they will also grow. So this is how the whole risk return matrix of financial assets are. Shall we move forward? Okay, we move forward. So as what I said, that each of us are having individual preferences, individual choices. Like that, as an investor, our choices get defined, our profiling happens based on our age and our temperament, and of course, our overall circumstances. So, the early age of 20 to 35, people are capable of taking higher risk. As you know, most of them, they do a startup, they do a new company, they join a startup because they love to create. They are not confined by the experiences which life gives. They are dreaming. So they are high risk taking. Of course, quite a few of them, they earn also very well. So this is the age group which is 20 to 35, which is high risk, high earning. As you move 35 to 50, your earning capacity definitely grows, but your risk taking becomes medium. Why? Because you're set with responsibilities. Responsibilities for your spouse, your children, your parents, up, down, sideways. All three ways you have responsibilities. So your risk taking becomes a bit less. And as you enter your 50 plus, you feel you've done enough. Of course, my earning capacity is good, but I don't want to take undue risk and undue, ventures which can destabilize my financial status. That so this way the risk profiling comes, based on which you decide your investment baskets and what goes for you to construct your portfolio, which means based on what is your risk profile and what is your goal, you will decide where your money should be put. Should you be putting your money when you want to create wealth, high risk, high return? So in growth, so equity, large portion will go. When you want a balanced kind of a scene, then some portion will go into debt, into money market instruments, into gold, and you want to only preserve your capital, then you put into lowest risk kind of an instrument. So somebody who is having, and we have all such crowd in our audience even today. So somebody who's having very large capital, then what happens is they want to preserve that capital rather than take undue risk with that capital. But those who are upcoming, they feel okay, any which way doesn't matter. I will rather take some investments in a venture capital or in a new startup and see if that becomes a five-bagger. So this is how the difference comes based on what is your goal your risk profile, and your objective is. Go forward, please. Now, there is one more concept, like we introduced three concepts. What is one first concept I introduced is of inflation. That inflation kills the purchasing power of your money. Then another very powerful concept we introduced was of compounding. Power of compounding, the eighth wonder. Now this is another fact which we all need to know, and that is interest rates has been, which means you save the money, put it in bank. In 91 you were getting 15% return. Today you are getting, it is written 6, but actually you get just about close to 4.5-5%. So the power of just putting in bank and sitting back has reduced. Next, which necessitates, but Piyush, can we go forward? Which necessitates for us to consider all the other available instruments. Now, what I have made here is a chart which talks about different available instruments and their average return. So, of course, savings bank account, see, it is written 3.5%. Even if you put it in bank FD, 5 to 6%, and always in red, what is written is taxable or tax-free. Now, when it is taxable, which means you get 5% return on FD, you take out 25% tax from that. So net return is only 4%. So you put 10 lakhs, at the end of the year, what will you get? 4%, 40,000. So by putting into just bank, you are putting at only getting return of 40,000. Then there are other fixed income instruments, as you can see, which is, as what I said, RBI bonds, senior citizens bond, Pradhan Mantri bonds, then bonds and debt mutual funds. That is another way of putting your money into fixed income if you don't want to take equity risk, which gives you 6 to 9% return, but that is taxable again. We have not shown real estate and gold here because both of them do not give any fixed kind of, not fixed, but they do not have, except gold bond, which is give 2.5%. There is no trend in that. And then there is equity and equity related funds, which is 12 to 15%. Now, how have we arrived at this? Based on 10-year, 20-year, 30-year trend of index returns. So this is the horizon of assets and their returns. This is just one more way of depicting this thing, that it is a very popular rule in finance market, which we call it rule of 72. That by dividing 72 by the annual rate of return, we come to know in how many years our money will double. So let's see how each instrument will take time to double our money. So if I keep putting money in my savings bank account, it will take 20 years to double my money. And if I put it in equity index fund only, it will take 5 years to double my money. No rocket science of finding out the best particular stock based on past data. But people will have so many questions who are a little more familiar to market. No, but last 3 years index returns are so bad. My mutual fund money is same. I say you see any period of 10 years, you'll find this return. But you will take any shorter period in equity markets, you will not get this kind of return. Okay, can we move forward, please? Correct. So quite a few of you who would be looking at markets closely, maybe investing also for you or your husband, or maybe husbands themselves or children, would have all these products, all these questions. Are not markets too high? Is it time to buy or sell? And this question has always been there. And the seasoned professional will always tell you that you're not buying markets. You are becoming partner in a business. Business underlying will keep growing if you have selected right management and right business. So if the stock price goes up or down, don't bother too much. Always there is opportunity to buy good businesses. But whether fixed income, how much into equity, how much into real estate, that is a very judicious decision which you need to take along with an advisor. Now, just to further introduce that which way you all can participate in equity. A, when you want to take help of advisor, you can go through mutual funds. But what happens in a mutual fund? What is the difference between a mutual fund and a portfolio management scheme? For example, in mutual fund, millions and millions of people put their savings, because of which, A, the sizes of those funds are very large. B, the ability of the fund manager to move positions is also restricted. While PMS and AIF have slightly smaller sizes of funds, they can tailor make a few portfolios. So based on your risk profile, you can help construct your portfolio. The other route of participating in equity market is direct. And within direct, it is very important to know that there is a distinction. What is the distinction? Trading or investing. What is the key difference? When you trade, which means you bought the stock of Maruti today with the intention that from 6,800, within 1 month, it will go to 7,200. You don't want to know what will happen in 2 years, 3 years. And if from 6,800 it goes to 6,500, you will come out of that stock. That is trading. But when you want to invest, you will do what? Oh, this is a Tata company. They have come out with one of these very good product. This pharma company's product is the best in the world. They will do very well. So you will do little more finding. You will say that over 5 years, their business will grow so much. Then you will stay put into that particular company. That is investing. While you invest, you watch the business. While you trade, you watch the price. So we cannot mix the two. There are different principles for trading. There are different principles for investing. There are different techniques to learn trading. There are different techniques to learn investing. Okay, we move forward. So now, having understood that our savings to investments journey meets with different asset classes like gold, real estate, art, fixed income like bonds and debentures, and equities through different mediums of mutual fund or PMS, etc. How do we get participated into it? So most of us, it seems to me, that are still looking at wealth creation rather than fixed return. And some part of the portfolio definitely remains into fixed income for any emergencies. So that definitely remains within the bond side, within the fixed deposit side. But large part of the portfolio remains in equity. And the better way of doing that for initiators. Now, if I'm addressing somebody who's into the markets, then there are different other ways to talk about. But then for them, these audience, I think SIP is one of the very good way. Now, what is the power of this SIP? A, you are spreading out your investments over a period of time. Now, SIP is systematic investment plan. So, say 2 months back, markets were very high. Today, markets have corrected by 1,000 points. Once again, after 3 months, market will be very high. So I keep on wondering, when do I invest? When it is down, I feel worried. When it is up, I feel it is too high. The best way to get over this is systematic investment plan. So month over month, you decide a fixed amount, which keeps going into either some mutual funds or into some PMS, or a dedicated portfolio of 10 stocks, which you have decided along with your advisor, and the money keeps going. So it gets averaged out. When it is low, also you get the entry. When it is high, also you put. Your average cost remains low. Can we move forward? And of course, we knew the power of compounding. So starting investment at an early age is so advantageous. You will just come to know that in a second. Can you just start that? So, for example, one of our sons start at the age of 20 and he puts 50,000 rupees as in systematic investment plan per month. Every month without fail, he puts 51,000 rupees. And now please think, what will he get at the age of 60 when wants to wind up, hang his boots by putting systematically only 51,000 rupees. Now, most of our children below 51,000 over 2 weekends, if not one. But if he does that, think in your mind, what will be the kitty he'll be sitting on when he's 60? Any replies on the chat, please? The amount will be, Piyush? Yes. At 60, he'll be sitting on 60 crores. This is the power of A, compounding, B, discipline. And you all mothers, up till now, you all have taken care. No, you have to have this soup daily. You have to do this for your skin. You have to do this for your good health. Eat a banana, XYZ. Now is the time you tell your children. Now this 51,000, maybe our families can afford much more. You put 5 lakhs if you can a month. You put 50,000, you put 1 lakh a month, and imagine 1 lakh a month will become 120 crores when he is 60. Now you just don't want to plan for this long a period. Or you have reached 30 years, then you need that 51,000 will become 1,70,000 per month for that person to achieve 60 crores. If he is 40 years, he'll need 6 lakhs a year to reach 60 crores by 60. And so on and so forth. Now see, when you start at 50, it becomes a little difficult. How will you put 26 lakhs a month every month? Looks a little difficult. But how simple it looks when you start early at the age of 20, just 51,000. Damn simple, damn easy to do that. This is the power of early investing and power of compounding. Okay, next. So there are very many emerging trends and themes by which we can invest. Sure. This is about what are the different avenues from wealth basket. Of course, mutual fund, equity and debt. We just discussed direct equity, but there are listed and unlisted direct equity, which means listed on the exchange where prices are there daily. Unlisted meaning businesses which are still not, IPO has not come. Now there are US investing possibilities also to participate in this company Zoom. Also, you can buy Zoom shares, you can buy Apple shares, because as Indians, we can put money into US markets also. Yeah, correct. Can we just go over to Wealth for Women portfolio? I'll take 10 minutes of all of you and introduce you to this new portfolio, which I think will be very suitable for those who are interested. Piyush, can you put that presentation, please? Lovely. Can you take me to the next one, next slide? Particularly because on this Women's Day, I launched this, particularly to suit women's requirement. And what is this all about? This is one-stop investment solution for women, because it is over different asset classes. It covers gold, it covers fixed income, it covers US investing, it covers equities, and it covers bonds and debt also. And what we do is we participate through index funds. So we don't go into the detail of, so one of the key risk in participating in equity markets is what? You become partner with people who are either not disciplined, or people or management who are not transparent. Now, what do you mean by not transparent? What it means is that you get benefit only when the management shows all the profits in the books. If they take out cash, then we as their shareholder don't get the advantage of the profit. So what is most important in stock selection is as what we call transparency of the management, that whatever profits they make, they show it in the books. Now to select that itself becomes very difficult. So what did we choose? That we will participate for our fellow women through index fund. Now in index, most of the stocks which come, they are bluest of blue chips. So we don't carry any of those risks. And also they're diversified over 30 or 50 stocks. So we don't have too much exposure on one stock. So in Wealth for Women portfolio, what we have done is we divide through our proprietary meters the asset which is given across different asset classes. Can you take it forward? Take it forward. So which are those asset classes? Keep it up. One slide up. Yes. We invest into Nifty fund, then Nifty mid cap. So companies where which are slightly smaller than the largest companies are called mid cap companies. And these companies tend to have very good growth. So we also invest into them. We invest into gold, bond, then gilt is what? Government securities, 100% safe. Then liquid funds at times when we feel everything is too risky, there is a war, sometimes then we put all the money into cash, that is liquid. And we also put money into NASDAQ, which is the US technology index, where all the leading world technology leading companies are listed and we can get to participate in that. So we build portfolio through these assets. And how is the portfolio done? Can you just... So this is the way to know how a particular scheme is doing. For example, there is comparative return given here. Vis-a-vis, say for example, gold. Okay. So over 5-year period, gold, if you see fifth column, has given a return of 8%, 7.8%. In CAGR, 5-year CAGR of gold is 7.8%. Gold, Piyush, gold, next to it. Don't keep the arrow if it is not, perfect. While the Wealth for Women portfolio is given CAGR of 25%. Now you all know what is CAGR. That is compounded return is at 25% for 5 years. What is Nifty given 5-year return? 17%. What is mid-cap given return? 17%. NASDAQ is given phenomenal return, 26%. Then gilt fund, that is government securities, have given what? 5-year return? 8% per annum. But for each of the 5-year, 8% return. Like that, you can see return for all different asset classes. But because we kept on moving from one asset class to the other, depending on the different parameters, our returns have been this. So here also you will have to take long-term vision in mind and continue to remain invested. It is a very low risk kind of a portfolio. And sometimes when markets are very, very strong, it will not match market returns. For example, if you see in last 6 months, mid-cap has given 36% return, while this portfolio has given only 21% return. Why? Because we spread ourselves into different assets. But when you see 1 year, this has given 55% return, which is against all asset class, it is highest. So in short term, it might look like that, oh, something else is moving faster. But in medium term, this will give the best return by shifting between different asset class. So this is a summary of today's session for all of you. So just to give you summary of today's discussion, we saw, as we start with again the need for savings, we saw what can eat away our savings if we are not well insured. We saw that savings alone is not important, but investments is important so that inflation doesn't eat away our savings. We saw power of compounding, which means when you continuously keep remain invested and the return on investment is also generated on return, then the returns are unbelievable. We saw different asset classes in which we can put our money, and we also saw what are the traits or qualities of those different asset classes, be it bond or gold or real estate or equities. And then finally, we saw the power of early investing, that just a 50,000 a month can lead to 60 crores of kitty, which means you can plan your any event in the future, be it retirement, a marriage, an education, anything can be very well planned with discipline. And on the top of everything, we finally saw a product tailor made for women. Now, with this, I will wind up. We will do a small poll and we also open the floor for question and answer. 70% of you have voted.
And there's almost like a huge demand for the question number 3, which is the session on stock selection and portfolio building.
Lovely. Lovely. Okay, now can we just keep the floor for a few questions, please? How will you really allow that?
Hello, Amisha.
Hi.
Hi, this is Madhu Gupta. Your session has been very interesting. And well, at my advanced stage, I don't know whether what I can learn now, but definitely I would, somebody like me who keeps on getting money from the husband's business, would like to invest for myself for next 20 years, because keeping in mind good health practices and good medical practices which are available to people like us, we should, people of my age should plan for the next 20-25 years.
So
and
true.
a one-to-one session with you would be of great benefit to me, and I look forward to a meeting with you to plan how to invest my money wisely, because very frankly, my husband is only, he's so busy running his business that he just parks it in government bonds and lets the money be. But I would like to learn how to start trading or investing for the next 20 years of my expected life. And
absolutely.
yes, and enjoy more benefits out of that money. Have a gala tie. And also leave a good
so true, Madhuji, I completely agree.
And leave a good amount of portfolio for my kids and my grandkids.
Absolutely. And this is what I want each of the women to take charge of, because husbands definitely are more busy, and I frankly believe a lot that women are such a good risk return balancer.
Oh, believe me, I am the gambler in the family.
No, but they still balance the risk and return.
Yeah, we can balance it. And I think this product which you were showing for women with the investment in gold and bonds and art
Correct.
and things like that. That is a very balanced way, and I think I could begin with that. I am one of your
Lovely.
clients. I'm
Lovely.
convinced.
Lovely. Thank you.
Thank you for a very educative session.
My pleasure. Absolutely.
We have two more questions. One is from Ms. Sonal Shah. She's asking for your suggestion on SIP on women's portfolio.
Okay. Yeah. Hi, Sonal. Yes, definitely in women's portfolio also SIP is possible. So, somebody from my office will definitely connect back with you and explain you how to go about that SIP. But it is possible.
Then we have another question from Ms. Shobha Maladi. She's asking, should we keep investing in long-term equity or also book profits?
So the decision should be taken based on two things. A, is the business at this juncture also looking very interesting and a very good growth is still possible, or some new competition or some disruption has come because of which the business may not look as strong? And secondly, it is a slightly more nuanced reply that what is looking good as a business, is it equally strongly valued, which means the price captures it all? And that requires a bit of nitty gritty as to how much is there in the price and how much is not there. So that itself is the full science of stock market. But at times when the business either is not looking as good or prices run up much ahead of the business fundamentals or business profits, only in either of the two, by properly assessing, you should book profits.
I think we are almost through with all the questions.
Correct. Thank you very much, everyone, for taking out. Hope it was useful to all of you.
Thank you,
so
Amisha.
much.
Thank
Amisha,
you,
really
Amisha. Very
enjoyed.
informative session. We
Thank
shall
you,
continue
Rose.
it tonight.